We've been doing this factor investing that I know everybody's talking about for a long time. We actually trademarked that term over 10 years ago in the use of mutual funds before everybody knew what that meant. But basically what we do is we look at baskets of securities around the world and we weight securities based on certain characteristics. I think one that's interesting today is to think about growth stocks, which we're all talking a lot about, and what happened in October. But we think carefully about how to think about value characteristics amongst growth stocks. So for example, research and development, intangibles, the people that work there, the ideas that these companies create, they don't really show up in book value the way accounting standards work. These assets are underappreciated. So imagine searching through a group of growth stocks globally, looking for companies that have lots of intangibles, and making an adjustment to think about their value versus traditional book to value, price to book measures.
So it doesn't sound like something an individual could undertake. How can you help individuals? What have you found out using that approach? What should we do?
Well, what we do find is that, within growth stocks, for example, companies that have large amounts of R&D over time tend to outperform companies that don't. Now, we're talking about sectors earlier. If you think about it right now, the healthcare sector, consumer discretionary, information technology, these are examples of sectors where you really have to think about their intangible assets because they have, on average, higher amounts of these things. And some of the companies that have more of this than others are likely to show up as very expensive if you just look at their price to book. But ultimately, they may be cheaper than you think if you consider these intangibles as important assets of these businesses. So you might just think about sectors where this could benefit them. I think healthcare and technology are probably two good examples of that. And it tells a different story than traditional valuation measures.
Tom, you make any sense to you?
Well, yes and no. So I'm a former accountant. So R&D is expensed, whereas if a company bought a building, they get to put it on the balance sheet. So I guess you're saying, hey, this R&D disappears because it shows up as an expense. I agree. I think a lot of technology companies have built monopoly platforms. That platform doesn't show up on the balance sheet because it has been an R&D funded endeavor. I think Amazon is really an asset company, so people should say this asset's worth this minus the liability. This is the value of the equity, and you realize the equity is really cheap. So I think there's a way to look at tech as actually a value sector because there is this sort of perpetual asset value.
Well, I think within growth stocks in particular, we generally have to. Certainly, we all own growth stocks. I mean, certainly they've outperformed value by a lot over the long term, recently anyway. But I think people are questioning that. But imagine this idea of you have to think about how can I create some form of value tilt within my growth securities. And one way to do that would be to think carefully about these intangibles. And there's been a fair amount of research done on this. I think it does, especially, you look at companies like, Amazon is a good example. If you look at their price to book with or without intangibles, and there's a lot to say about that, it tells a very different story. Could Amazon actually be thought of as a value stock in a sense?